If you looked at your portfolio on Friday afternoon, January 30th, 2026, you probably felt a knot in your stomach. You probably felt that cold, sinking sensation that only comes when you watch years of hard work evaporate in minutes. You saw red everywhere. You checked your stocks, Nvidia down, Microsoft down, Tesla hammered. You checked your crypto, Bitcoin crashing through $80,000, altcoins decimated. You checked your safe haven assets. You checked gold and silver. They were down even more. Silver crashed 25% in a single session. Gold erased $3 trillion in market cap in hours. This wasn't a sector rotation. This wasn't a tech bubble bursting. This was something much rarer and much more dangerous. This was an everything crash. In the span of roughly 36 hours, from Thursday night to the closing bell on Friday, an estimated $7 to $9 trillion of global wealth was wiped off the ledger. $7 trillion. To put that in perspective, that is the entire GDP of Germany and Japan combined vanished in a day and a half. It is bigger than the 2008 Lehman Brothers collapse in terms of raw dollar value. And yet, if you turn on CNBC or read the Wall Street Journal, what do you hear? You hear calm voices. You hear experts talking about profit taking. You hear them blaming technical factors. They are lying to you. You do not wipe out $7 trillion because of profit taking. You do not see gold, the ultimate safe haven, crash in sync with Bitcoin, the ultimate risk asset, unless something is fundamentally broken in the plumbing of the financial system. What we witnessed on Friday was a liquidity crisis. It was a margin call from hell, and it was triggered by three specific events that converged at the exact same moment to create the perfect storm. The Federal Reserve's shock decision to pause rate cuts, Donald Trump's escalation of the war on the Fed, the sudden geopolitical flare-up with Iran. In this video, I am going to break down exactly what happened, why cash suddenly became the only thing that mattered, and why this crash is actually the biggest fake out in history. If you sold on Friday, you fell for the trap. If you are holding cash today, you have the opportunity of a lifetime. Let's start with the Fed shock. For months, the market has been pricing in aggressive interest rate cuts. Wall Street was 100% convinced that on January 28th, the Federal Reserve would cut rates, flush the system with money, and keep the party going. But Jerome Powell, or perhaps the ghost of Jerome Powell, given the pressure he is under, did the unthinkable. He paused. He came out and said, inflation is still too sticky. The labor market is too resilient. No cuts. The market was addicted to cheap money, and the dealer just cut off the supply. When the market expects liquidity and doesn't get it, what happens? Withdrawal symptoms, violent shaking, sweating, withdrawal symptoms. Hedge funds that were leveraged 10 to 1 on the expectation of lower rates were suddenly underwater. Their algorithms screamed, sell, and this is where the liquidity trap snaps shut. When a hedge fund gets a margin call, they don't sell what they want to sell. They sell what they can sell. They sell their winners. They sell their gold. They sell their Bitcoin. They sell their Nvidia stock. They sell anything that has a bid to raise cash to cover their losses. This is why gold crashed. It wasn't because people suddenly decided gold was worthless. It was because gold is liquid. It was the ATM machine for Wall Street. They smashed the piggy bank to pay the rent. This is a classic correlation of one event. In a normal market, when stocks go down, gold goes up. They are inversely correlated. In a crash, in a liquidity crisis, the correlation of everything goes to one. Everything goes down together because everyone is rushing for the same exit door at the same time, screaming for cash. But there is a second layer to this crash, a political layer that makes it much more terrifying, the Trump factor. We know that President Trump is currently waging a war on the Federal Reserve. He has explicitly stated he wants to fire the leadership. He wants to dictate monetary policy. He wants a weak dollar to boost manufacturing. On Friday, rumors began to swirl that the Trump administration is launching a formal investigation into the Fed's decision-making process. This terrified the markets. Why? Because the one thing that holds the global financial system together is the belief that the U.S. central bank is independent, that it isn't just a piggy bank for the president. If investors believe that Trump is about to take over the Fed, the risk premium on U.S. assets skyrockets. Foreign investors, Japan, China, Saudi Arabia, look at this chaos and say, I'm out. I don't want to be in the middle of a civil war between the White House and the central bank. So they sold. They dumped treasuries, they dumped stocks, and then The cherry on top, Iran. Just as the markets were wobbling, news broke of rising tensions in the Middle East, Trump announcing U.S. military advancements towards Iran. In a normal world, war news sends oil and gold higher. But remember, this was a liquidity crisis. The fear of war caused a spike in the U.S. dollar. The dollar index DXY ripped higher. And since almost every asset on earth is priced in dollars, when the dollar goes up, everything else goes down. The strong dollar acted like a wrecking ball. It smashed the price of silver. It smashed the price of crypto. Let's look specifically at the crypto carnage. Bitcoin fell to $80,000. Why? Because crypto is the most sensitive asset to global liquidity. It is a sponge for excess cash. When the Fed turned off the tap on Wednesday, the sponge dried up on Friday. Over $1.7 billion in leverage was liquidated in the crypto markets in 24 hours. That means traders who were borrowing money to bet on Bitcoin were wiped out. Their positions were forcibly closed by exchanges. This created a cascade effect. Price drops, margin call, forced sell, price drops more. It is a death spiral. But here is the Markology truth. Here is the part the media won't tell you. The asset is not the price. Did Bitcoin stop working on Friday? No, the network is fine. Did the gold bars in your safe turn into lead? No, they are still gold. Did the AI revolution stop because Nvidia stock went down 8%? No, the GPUs are still humming. The price changed? The value did not. This is the disconnect that creates millionaires. When the price disconnects from the value because of forced selling, that is a gift from the gods. Look at the silver market. This is the most obvious smoking gun. On paper, silver crashed 25%, but try to buy it. I challenge you. Go to a dealer right now. The premiums didn't crash. The premiums went up. This confirms that the crash was paper. It was derivatives. It was digital contracts being dumped by panicked bankers. It was not physical metal being sold by real owners. The physical market is screaming shortage. The paper market is screaming surplus. Whenever you see that divergence, you buy the physical. Every single time. So, what happens next? We just wiped out $7 trillion. The wealth effect is gone. People feel poorer today than they did on Thursday. This is exactly what the Fed didn't want, but it's what they caused. Now the panic shifts to the policymakers. The Fed cannot allow a $7 trillion hole to remain in the balance sheet. A crash of this magnitude threatens the banking system. It threatens the repo market. It threatens the solvency of pension funds. So here is my prediction for next week. The pivot. The Fed will panic, Trump will scream, and the pause will turn into a panic cut. They will have to inject liquidity to stop the bleeding. They will have to print money to fill the $7 trillion hole. And when they turn the printer back on, that is when the everything rally begins. That is when gold goes to $6,000. That is when Bitcoin goes to $150,000. The crash on Friday was the shakeout. It was the final test. They shook the tree to see who would let go. The weak hands, the guys trading on margin, the guys who got scared, they let go. They sold their assets to the strong hands. The guys who know that the money printing is inevitable. You have to decide which hand you are. Are you the guy who sells at the bottom because CNBC told you the world is ending? Or are you the guy who buys the wreckage because you know the math? The math says the U.S. government is $38 trillion in debt. The math says they must debase the currency to pay it back. The math says that a liquidity crunch in January 2026 is just a speed bump on the road to hyperinflation. This $7 trillion wipeout is a glitch in the matrix. It is a temporary dislocation caused by leverage unwinding. It is scary. It hurts to look at the screen. But if you zoom out, if you look at the 2008 crash, it was the best buying opportunity of the decade. If you look at the 2020 crash, it was the best buying opportunity of the decade. The 2026 Friday Massacre will be no different. Do not let the volatility shake you out of your conviction. If you own high-quality assets, productive tech stocks, scarce crypto, physical precious metals, you sit on your hands. You do nothing. You turn off the screen. Or, if you have cash, you go shopping because everything is on sale. The banks raided the COMEX. The Fed spooked the bond market. Trump rattled the geopolitical cage. Chaos creates opportunity. The $7 trillion didn't disappear. It just changed hands. It went from the impatient to the patient. Make sure you're on the receiving end of that transfer. I will be watching the Fed's emergency meeting minutes. I will be tracking the reverse repo markets to see when the liquidity comes back, because it will come back. It always does. And when it does, the rebound will be violent. Stay calm, stay liquid, stay solvent, and don't let them scare you out of your future. Subscribe to the channel. We navigate the crash together. I'll see you in the next video.